Jeff is in Toronto. Go ahead, Jeff.
Hi, I'm just wondering if you could comment on the pipelines, Canadian pipelines, which seem to be going nowhere to down in a low interest rate environment, and in particular, Enbridge or TransCanada, and why they seem to be getting particularly hurt today. Thank you very much. Bye.
Okay, thank you.
So, Jeff, you're right. We are in a low interest rate environment, and the pipes are something that somebody would own if they believed that we're in a low interest rate environment, staying in a low interest rate environment. You know, there's obviously outside influences like the volume growth of producers to go through the pipe. And what we saw was from 2009 to 2014 an enormous boom in production that meant the tolls went up a lot. And as they went up, the earnings went up, cash flows went up, dividends went up, and the multiple investors were prepared to pay went up. They turned into growth stocks. And then volume growth has kind of slowed down. So the multiple has been compressing. Now, when we talk about rates being low, they have been low. They've been at a generational low. In fact, you know, in Europe, at a 1,000-year low. In 1946 was the last low in interest rates at 1.8% on a 10-year bond. And then rates slowly rose until, well, 1980. And we believe that we saw secular, a generational low in rates last June, and that since then rates have slowly been ticking higher. They rallied into the year end. Rates fell a little bit into August of this year and seem to be ticking higher again. So if you look at the sectors that are hurt by rising rates, utilities, telcos, REITs, the things that they would call bond proxies, they have been underperforming the market. And if you look at the sectors that are leading this market, industrials, financials, technology, some basic materials, those are cyclical, reflationary assets. So it's not for me to say what should work, but I can tell you where the breadth is expanding is in the reflationary sectors. So, you know, when you look at who owns this stuff, everybody owns bond proxies, right? Everybody's bought them for the yield. Mm-hmm. And if you look at what did well in the 50s and 60s in the last interest rate cycle, it was things that had economic sensitivity. And as prices went up, they had an ability to raise prices, and they grew their dividends, mm-hmm. and that's what led the market. So this is where I would focus. I would not focus in the bond proxies. We have almost no exposure to bond proxy sectors currently.
Even though you're not keen on the pipelines right now, relatively speaking, if somebody twisted your arm, would you choose TransCanada or Enbridge?
I'd pick Kinder Morgan. KML, you know, it's
neither of the big Canadian ones.
Well, no, this Canadian, Kinder Canada.
Oh, sorry, Kinder Canada.
Kinder
okay,
Canada.
I thought you meant in the States.
Because you know, if they can get their approvals, they can triple the volume in their pipe in the next 3-4 years. So that gives you something to offset rising rates. What you need is volume growth and something to offset the impact of rising rates. And so I would prefer to look at a Kinder Morgan.
Okay, intriguing idea there. Jerry in Vancouver, go ahead.
Good morning, David. Can you give me your view on Cisco Systems going forward for the next year or two? It's at its 52-week high just about. Would you be a buyer at this level, or would you hold? And Andy, could you give us a street consensus?
I will have a look. Okay, sure. Thanks very much.
So, Jerry, since the market tipped up in February of 16, we've really been rallying for sort of 18 months. It's been a very steady rally, and the leading group off the bottom was technology. Almost always the group that leads off the bottom is going to continue to lead through the course of the cyclical rally, and that's what's been happening. And within technology, you've got, you know, software as a service, which of course Cisco is not. You've got cloud-based computing, which it has some association to. You got the Internet of Things. Well, there's a checkbox because certainly Cisco is part of the Internet of Things. And so this is a group that it continues to lead the market. Relative strength of the tech sector is continuing to hit new highs. Within tech, people say, well, they've gone up so much. But you know, if you take the whole tech sector, it's trading at 1 times the earnings multiple of the S&P. In other words, you're not paying a premium. Back in 2000, you were paying almost 3 times the multiple of the S&P 500. So that was really expensive. Some obviously more expensive than others, but old tech, Cisco being one of them, is not expensive. It's like 14 times earnings. They've got great cash flow. So, you know, it's trading at a discounted multiple to the market. And it's not the best stock in the group, but if you owned it, I would certainly hold it. I really like Microsoft in old tech, and we've talked about it a few times as a top pick. We'll talk about some more technology, I'm sure, today. But this would be, in our portfolios, we have about a 25% weight to technology, and there's some other stuff to do, but Cisco is fine.
Okay, and there are 8 holds, but there's 18 buys. Stock's around $34. The average target's only about 36. Jerry, thanks for the call. Natalie in Toronto, go ahead, please.
Thank you so much for taking my call. Mr. Burrows, you know how I value my opinion. You heard me ask you questions in the past. I've asked you in the past about NVIDIA, and I planned to buy it when it was like $40 cheaper. And my analyst watered me down, wouldn't allow me to buy it, telling me I'm a gambler. In the meanwhile, it's going up beautifully. So I'm wondering, should I still buy it for a long-term hold, or should I buy Micron? I heard a very high recommendation on Micron.
Okay.
Please give me your opinion. Thank you very much.
So Natalie, as you know, we own both of those stocks. NVIDIA has been the poster child for augmented reality, machine learning, and of course gaming. And this is all three of those are big secular growth areas, much bigger, I think, than people recognize. And so you pay up for the best company in that sector. There's always risk when you do that something goes wrong, but they've done a pretty good job. I mean, the stocks rallied pretty much from $14 to $197 a share, over the last 3 years, 2 years. We look at our positions every day, so would I buy it again today? And I would say, yes, I would buy it again today. But it's one position out of 25 or 40 positions. But it is the company in that space. Micron is a completely different company. It's also a great company. It's more cyclical. I mean, they're selling memory, storage. But that market over the last few years has become less fragmented and more controlled, and so pricing has been better. And there's lots of handsets being built. And I was at a meeting last week at Morgan Stanley in New York talking about this new iPhone. And their view is that people are underestimating the market opportunity for augmented reality, of which Apple now is the leader in handsets because they have the only unified operating system. And so Micron's likely to do well if the iPhone does well, and of course handsets are going to continue to sell. So I'd buy both. NVIDIA, more expensive, probably a longer runway. Micron, less expensive, but more cyclical. You'll have to time a sale better.
We'll be back with David Burrows of Barometer Capital Management. The topic today, North American large caps. Give David a call, 1-855-326-6266.